Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And as always, it's my pleasure to have the CEO of Zelman and Associates, Ivy Zelman, who I think is the best real estate researcher that we have around. And Ivy, welcome.
Thank you.
Yeah.
Can I take you on the road with me, Ted? That's quite the compliment.
Well, I'll tell you what, I'd give you a great testimonial for sure. But
Thank you so much.
You always have the best information, and we have this today for a lot of people to look at. But I know you start off talking about demographics and the real estate markets and various things. So you might just kick it off with that.
Sure. Well, I think our demographic outlook is quite contrarian and sobering, frankly, as we are concerned about the fact that household growth this prior decade we just completed actually grew at the slowest ever on record, and population growth grew at the second slowest on record behind the 1930s when overall growth was 7.3 and we grew 7.4%. So what we're looking at is a rather steepening deceleration. The trajectory is not our friend, and what does that really incrementally mean for housing is not positive. And so what we're seeing right now is a contrarian perspective that is suggesting that the pipeline of housing starts currently in the process, latest 12-month starts, are running above normalized demand in single family by as much as 20%, and in multifamily up as much as 10 to 12%. Now that pipeline has to get delivered, and the best friend of the housing industry right now is the governors on supply chain issues, and therefore delaying a lot of this production. But there's not only that pipeline, but it's what's coming behind it, especially in the build for rent market and in the production home builders, their footprint. So the demographics are concerning.
Let me ask you, you have a great slide on kids at home, and it's almost double what it was in 1980. So, I have thoughts about that myself, but where are you coming from on that?
Well, I think it's helpful to visually see it. It's concerning. Slide 4, where we show the number of 20 to 39-year-olds that are living at home, has gone, as you pointed out, up significantly over the past few decades. But what's been interesting is when you go from 2000 to 2010, the big increase that we had a 16.4% of that 20 to 39-year-old living at home actually increased over 300 basis points to almost 20%, 19.7%. At the end of 2010, or that decade, which we understood, Ted, that made sense, right? We had a great financial crisis that made a lot of young people were unemployed and had to go home and live with their folks. So we expected that to unwind over this prior 10-year period. In fact, we turned very bullish, what we called sort of the demographic recoil. You know, we were going to watch the coil just bounce back, and we'd see the unwind of that pent-up demand really justify being more constructive and was supportive of our calling the bottom in 2012. But rather than unwind, that incremental demand that we thought would come to fruition actually went the other way. We thought young adults for this past 10 years actually continued to live at home at an increasing rate. And so that's troubling to us, and we try to understand why, because unemployment obviously came down substantially. What is it right now that is resulting in these young adults staying at home longer? And there's a long list we can go through, but we were pretty puzzled by it. And it's not a point in time. You know, we look at this data annually, we can look at it monthly, and we're just not seeing the unlocking of what would be arguably pent-up demand as of right now.
That's interesting. So moving forward, talking about sales trends, you have a lot of great information on sales trends, but you might give us your thoughts beginning with that.
So we're talking new home sales or existing
homes? Well, you have a great slide on ownership data normalizing into 2020 and kind of where we're headed from there, and then sort of a look at absorption, from the prior peak.
Yep. So home ownership rates actually troughed in 16, and they've been steadily climbing ever since, getting back to more trend line of, call it, 64-ish, 65%. We did see a big spike early in the pandemic, and we think the data was just not, sampling errors with the pandemic. But generally, the upward trajectory in home ownership is really a benefit of millennials that have been aging into home ownership, and we think that those numbers are probably hitting where we may start to peak out. And that has a lot more to do with what we're seeing on renters becoming owners. If you look at the course of the last 18 months, we have historically, call it 2.3 million renters that become homeowners. That shot up throughout the pandemic to almost 3 million, and it has since declined back to that 2.3 million. So that level of moderation is reflective of what we believe is the absorption of a lot of the demand that's been in the market that we're normalizing. Our absorptions per community, which is what banks are going to underwrite, or what builders are buying land, they're going to, look at deals, and they're going to say, how many homes can you sell a month, and at what price, and what's the duration, which will determine, the returns. Right now, absorptions, which we show in that chart you mentioned, are running pretty much close to where they ran in the great financial boom period. And so, historically, builders would say, if I can sell one a week for a month, then that is a level that I can raise prices. If it falls below 4, then I'm more likely going to be challenged to raise prices. I might be incentivizing. So the rule of thumb is 1 a week, 4 a month. And right now we're running closer to 5 a month. We got to almost 6 a month. And so that's still elevated. So when I ask builders, what are you underwriting today in your assumptions? And a lot of them will say, oh, well, I'm only using 4.5. I'm like, 4.5? It's pretty strong. So your assumption is that this is going to continue. Absolutely. I think this demand is going to continue. And what's even more disconcerting is that what they're building is predominantly on spec, because they don't want to get caught in the inflationary pressures that they had, unfortunately, start to really see impacting their overall profitability. So rather than do a dirt sale, many of them are just speculating and selling it much later in the construction process, which adds risk because we don't obviously have buyers yet for those homes. So they better hope that their strategy of hope works and that they can, in fact, get those homes absorbed as we get more and more production into the market.
Are you seeing, Ivy, we noticing in the last year or so with inflation that, getting away from a lot of turnkey bids or just flat bids to more of a cost plus, even on a custom bill, they're building in a lot of cost adjustments on that, and I suppose all the builders are getting savvy on doing that. I guess you're seeing that.
Right. So the builders are being forced in some cases to use escalators, as they are seeing tremendous pressure on everything from labor to building products that are their inputs in order to reach their return hurdles. But I think that the consumer is pushing back on that, and I think that there's resistance. So there's more likely builders are speculating and waiting till they get further in the construction process before releasing the home for sale. So that we've seen a shift from cost plus, escalators to more of a speculative basis.
It's interesting too. You have two great looks at how year-over-year decline is moderating. The order decline and also the start to order ratio. Those are two great graphs you have.
Yeah, I think the start to order ratio is really critical. What we look at is that historically, call it a 1-to-1. You sell a home, you start it, and that's the way the industry historically has worked. But when you see it go above 1, in our case it's 109%, that implies that they're building more than they're ordering. And we had seen that get as low as 80 back in 2020, where they were not starting enough. So now they're going to that other extreme of building more than they actually are writing. I do think that, our view is that that's a speculative inventory building, and assuming that that's the strategy, I think it's only going to increase from here.
And you show that last 4 months of incentives really rising. I guess that's something
rising from a low base.
Right.
I think what you've had is like basically no incentives in the market. And so one of the, things that we are able to really ascertain from our private builder survey with several hundred builders representing, 15 to 20% of new home sales, which is over 95% correlated to the public home builders that account for 42% of the market. So we're really able to grasp what's going on at a local market level. And, incentives just were spiking in certain markets, like Boise as an example. was almost like a light switch went off, and the market just started slowing this summer, and it really slowed. And I think seasonally we're in a tough time of year, but you do see incentives, but they're still on the margin, I'd say, well below historic levels. But we're watching it closely because you go into Dallas where you got 75 production home builders, and you see a lot of construction in process right now. And it's like, jokingly, one builder said to me, he says, Ivy, says, winter's coming. He says, winter's coming, and there's a lot of inventory coming. And this is a smart guy that builds several thousand homes a year. So we'll see how well the builders manage the incentives as that supply starts coming to the market as available, and hopefully their demand is as strong as it is right now.
Well, I know, just a lot of banks will be watching this, and builders too. But you're talking about lot price inflation, and we keep seeing that. But it looks like the last 2 years has really been something.
Yeah, actually, we do a proprietary land development survey, and that survey is aggregating, 15 billion of land developer assets across predominantly the Smile states, but also throughout the U.S. and overall. You see lot inflation, for example, in Wisconsin, might be up 10, 15%, whereas in Austin or in Phoenix, it's up 100%. So the average is call it 34%. And that's nationwide, and that's a big spike from the run rate that we had been running in the teens. And so I think there's really the combination of the production builders, the land grab has been enormous. Their incremental land that they own and control on the balance sheet is also up over 30%, and they're spending and grabbing as much as land as they can, but they now have a new competitor. Their new competitor is the build for rent space. And that capital is just, you can't get enough of it. The capital allocation to that build for rent space is right now $75 billion, predominantly unlevered, with a small fraction actually already leased up, call it $6 billion, $10 billion in the pipeline. But it keeps coming. It keeps coming.
So, Ivy, on the $75 billion, you're talking about build for rent, and it sounds like they've only touched a portion of it. And that just seems like there's too much money there to create too much supply if those numbers worked out.
Well, I think that the real concern is that when you think about $75 billion and a small portion of it's actually been allocated and land has been acquired, it's very much concentrated in the same markets. And so in addition to the concentration geographically, let's say within Phoenix or Dallas or Houston, Atlanta, a lot of the markets where it's concentrated, it's also in the third ring of the market. So it's much more, I think, a risk for those third ring, call it tertiary areas, where they just assume that people are going to drive out there and provide significant amount of shelter. And where do all these bodies come from is what I want to know. And I think that's one of the things that when I talk to land developers and they're saying it's just dumb money buying these parcels and are driving up land prices, that land sellers are happy about it. But when you're using other people's money and you're using lofty underwriting assumptions, you can make anything pencil. And the question is, what are the investors going to say when they can't hit those hurdle rates that they've basically established? So I think there's a lot of concern that if all that capital gets deployed, but the pushback from the bulls, it's not all going to get deployed.
So you've done this a long time, and when we talk to people in Nashville and Raleigh and Denver, Phoenix, Austin, it's almost like they're drunk, and they can't. They think it's a never-ending situation. And what do you tell people like that?
Well, I think that our big thing right now is that, what happened? Did a light switch go on? And, the pandemic created, now everyone in the country is just moving and everybody's buying and free money everywhere. If you look at the Brookings Institute and the Pew Research Center, they just came out with a very disconcerting number that suggests that the United States had the slowest rate of mobility in 73 years, from 2020 to 2021. And that correlates with our concern that the level of demand in the market is not primary demand. The incremental, I should say, is more skewed to investors than people appreciate. So I'll give you an example. My father just bought a Lennar home in Humble, Texas. So he's right now in a unit in a building in Rice Village in Houston, Texas. He's got a condominium he still owns, and they now have a third property that they just closed on. So, he was out signing his closing or doing his closing yesterday, and one of the women who worked at Lennar was saying that she owns 9 properties, and it was telling my dad and his wife, and her boyfriend owns several properties. And I wonder how much of the demand, incremental demand that the builders are enjoying, are really coming from non-primary buyers in the market. So when you're at a party and everybody's wasted, nobody wants the sober person to say, hey, better stop, it's getting dangerous here. Everybody wants to keep partying. So we're in a new paradigm shift. The world has changed. Everybody wants to own. Everybody's going to leave their rental and go move out to suburbia, but not everybody can afford a rental or afford to buy. So builders are justifying providing shelter, homogeneous boxes that look just like the box a mile up the street that's a for sale product, and it's priced on a per square footage basis 20 to 30% more. So on a monthly basis, consumers don't really look at the per square dollar per square foot. But I have one example in a thematic piece we did on the build for rent market that we published earlier this year. Well, over the summer we published it, that literally you have a 4-bedroom, 3-bath, 10 minutes away from a rental 4-bedroom, 3-bath. The 4-bedroom, 3-bath that's a for sale is about $2,100 a month, and the rental is $29 something a month. And the build for rent operator got pissed off at me about it because he didn't like that I used his community. And he says, well, you don't account for the fact that people can't afford the down payment, or you're not accounting for that they might have too much leverage and they just can't afford to buy. I said, I appreciate that. Affordability wasn't the point of the report. And he said, well, you also don't show the difference in school districts because people will will pay more to be in the right school district. I go, you can sit here and justify whatever you want. You're building a box that looks exactly like another box, and there's a big price differential. And if you keep raising rents and home prices at some point correct, people are going to be more likely to go to homeownership and figure out how to come up with a 3.5% down payment. But that's the mentality right now. There's this rush of people that desire single family, and we need to provide all this production because not everybody can afford to buy, nor do they want to buy. They want flexibility in renting. And maybe there are people that rent because of by choice, and there are people that, of course, rent because of necessity. But we're going to be building communities out in the hinterlands, where the cows don't even want to live. For all these people are going to move from wherever they are right now. And the question is, where are all these bodies coming from? So that's what I keep coming back to.
And we see these outlying properties. And I'll give you a really good example in Austin, Texas, outlying example where we've been working with an investor who has some property up north where you have to drive to do what you're talking about. 6-fold bids have gone up in 1 year from what they wanted per acre. And they still haven't sold it, so it's kind of where they are. But you did have a great slide about what you expect in 22 and 23 in terms of appreciation changing a bit from what we'd seen the last 2 years.
Well, our expectation is at year end, we currently forecasting, and we think about home prices sort of at the end of the year, where will prices be? And we have it 14% forecasted, which is lower than the 18-19% that we're seeing right now, depending on FHFA, Case-Shiller. But that's because of seasonal adjustments that tend to weigh down the latter part of the year. And I would just say it's probably going to be closer to 15% at year end. But in 2022, we're looking for 3% growth and 1% growth, 22 and 23. And that's a significant moderation. And I think that's really reflective of the supply. It's all about supply. So if we're right and all this supply does come to the market, we don't get more bottlenecks and supply problems that delay it even further, that supply will weigh on pricing power. And builders that are producing, the big right now been the big gripe for the investment community, for the public builders, is they have not been able to grow their store count. And the store counts have been down pretty much all of 21. So now they pound their chest, they get on their earnings calls, they say, we're going to grow community count 20%, 40%, they're going to all grow. And that's a hard number for them to predict. But the land grab and the new communities that they plan on bringing on are really a function of what we believe will drive prices lower in both the existing and the new market. More so the new market, we actually have negative national home prices of 1% in 23. So we're expecting the new home market will see more of a correction than existing homes, and that's barring no increase in rates. I mean, we could sit here all day, Ted, you and I, and talk about where rates are going, whether it's deflation, inflation, stagflation, but assuming no rate increase, I still think the supply will weigh on pricing power.
And you also mentioned that, if you look at the last 3 quarters, that I suppose with the home prices going, the whole thing moving forward, these monthly payments obviously have been accelerating quite a bit, and that has to have some impact on entry level.
Well, that's why I said the number of renters in the United States that became homeowners has moderated. I mean, when you go from, call it 2 to 2.3 million, and it shoots up to almost 3 million, way above trend line, and now it's right back where it was on a trend line basis. There's affordability pressures, and the monthly payment for the fourth quarter year over year is up 21% for the consumer buying a medium-priced home using an FHA mortgage. That's with really virtually no rate increase there. So affordability does matter. And what's amazing to me is that when I talk to builders and build-for-rent operators, they believe demand, Ted, is price inelastic. I've never heard that before in my life. So
only at the top.
I won't pick on the management team that said it, but I will tell you a public management team said that we have a massive deficit of shelter, and therefore we have infinite pricing power, and consumers will reallocate their disposable income to their shelter away from discretionary type purchases because they want to live where they want to work, where their kids are and their families are, which ironically just suggests that there is multi-generational living. And yet all these people, if they're living because they work there and their families live there and their adult children live there and their adult parents live there. So anyway, I get off my soapbox, but I just am just amazed on the complacency that affordability is not part of the equation, nor do they think that home prices that were in the $200,000 range that are now in the high threes in some cities. I mean, we're maybe in some secondary cities you can find homes priced in the twos, but generally in your Austin, there's right. I mean, they've got to drive way out to make the land even, possible for them to acquire. And that's just what we've seen in prior cycles. This is how they get in trouble. They start drinking their own Kool-Aid.
Well, and on top of that, I'll move into another area, but you have I have a lot of great stuff from multifamily, but I have to tell you, Ivy, 3 weeks ago, I saw the first multifamily apartment sale at a 2.9% cap rate. And so the only thing I could think about was you completely betting on the come here.
Well, their confidence, it's interesting because, I spent a lot of time with multifamily developers and operators, people that are focused on, value add. And their view is right now that there's so much money chasing a finite number of transactions, so they have to build more. So we're seeing development yields that they're basically expecting unlevered, call it 5.5%, which is a better deal than, the prevailing cap rates, and therefore they can justify it. So it's hard to see that yet the development yields have not compressed despite inflation. So kind of like, well, what are you underwriting? How do you get to a development yield that doesn't get negatively impacted because of all the inflation that we see in building products and labor and land? So I think that the multifamily market is drunk on euphoric free money. And I'll tell you, I talked to the big three that are in the market, and they will tell you that they have no choice, because when you raise the amount of money that they're raising and you're promising, low double-digit levered returns, you better start producing those returns, but you can't make any money, Ted, if you don't allocate the capital. So what we're seeing is skyrocketing development happening in suburbia for multifamily. And the metrics for every metric that we track for current operators that are leased up are pretty much close to or at near record levels. So the justification is, well, look how well we're doing, and look at our rent rolls, and look at our loss to lease rates, and look at our turnover, and everybody's extrapolating the current environment, assuming it's sustainable. It's the only way they can do it. I mean, our rent rolls at 7% blended rent growth, is that going to really be sustainable? So, and people, they believe it is. So I actually was on the driving range this weekend, and I met up with one of my buddies who's in the industry, mortgage lender, and he's living in an apartment, and he's waiting for his house in Austin to be built, and he's moving from Houston to Austin. So there's an example, the dual properties. So how much of our occupancy today is really being fueled by people that are in transition, or they're waiting, not just necessarily for their house to be built, but maybe they're temporarily just wanting to get out of a dense area, so they move out to a single family rental in a temporary situation. In fact, one of the post office data pieces of the Pew Research Center and Brookings Institute is that it's really about the best way to track mobility is by change of address requests at the post office, because that's actual data that you can look at. And the number of families moving is down substantially. The number of individuals requesting an address change are up, but a lot of it's temporary. So it's just an interesting thing to sort of contemplate how much of this current demand that's driving occupancy and therefore pricing power is just transitory. That's our favorite word for 21. Transitory.
Oh, yeah, we're all tired of that word probably. But the last thing I'd say on multifamily, you talk about really, I guess it's maybe, is it an all-time high on backlog for multifamily, or?
I think it's the highest since the 70s. So it's
really?
Definitely, yeah. And, in the 70s, we just reported today our apartment transaction survey. And when you look at the level of overall sequential change in return from the benchmark that the National Association of Multifamily Housing Council reports, was the highest since 1979. So it's 6.5%, highest since 79, 80. And we had double-digit inflation when those returns were realized. So just to give you some perspective.
When you talk about new move-in rents at a record high, you're talking about monthly rents. Is that what you're speaking of?
Correct. So someone who's moving in, what they would pay relative to what the rent was from the prior tenant are running right now in the teens, which is just insane. And what they're able to do is adjust the rent to a much higher level, but on a same store basis for a renewal, you're really running more in the mid to high single digits depending on the market. So new move-in is adjusting to whatever the baseline rent is, but the blended is the more important variable.
And on that same subject of move-in, I'm just switching to basically build for rent. I assume they're filling those out too, and increasing those prices as well.
Oh yeah, same. The numbers are even bigger with respect to appreciation, and lease rates are running hotter than they are in multifamily, but pretty comparable on a relative basis. They're both in the teens. I mean, you're seeing 15, 16% new move-in rates. It's hard to look at a new move-in rate with having sort of apples and oranges, because you don't have a previous tenant that you can really see the same store rate of increase. But yeah, the metrics in BFR and SFR overall through our proprietary SFR survey are at predominantly all record levels right now. 98% occupancy, double-digit new move-in, high single-digit blended rent growth or renewal rent growth, and turnover is at an historic low. So it's euphoric.
And it's interesting. You had I've never seen this graph. You had the graph on the who accounts for the build for rent pipeline, and you had Phoenix in there at almost 20%, but you had 4 Texas cities in that top piece, which I found interesting. I wouldn't have thought it would have been that much, but obviously it's fairly high.
Yeah, well, Texas is a pretty pro-business friendly place to do business. The zoning restrictions are nowhere as stringent. Austin, definitely the most of the Texas MSAs, but it's really the Carolinas, Georgia, Arizona, and Texas are the leaders in terms of build for rent right now.
So in wrapping up, and you have just your macro forecast, okay? You talk about starts and really home closings, various things you look for. Just in general, what do you just generally see for 22 and 23 if you had just a macro comment about it?
Well, I'm going to make the assumption rates aren't going to go any higher, just to give you a baseline how we think about the market. And we'd say that, it's all about supply, and supply leading to moderation. And while demand could remain elevated, I think that it reminds me the parallels of the current environment, and although very different, is that we look back at securitization data on mortgage origination for Fannie and Freddie from '04 to '05. We saw incremental demand was all investors. The primary buyer sort of just held at the levels they had been, but they weren't growing. And a lot of that was due to the lack of affordability. And I think that the investors were really driving it. Today, I think that the incremental demand is going to start to really moderate more so for the primary buyers because of affordability. And we're going to see more supply that will result in moderation. But the investors might be there for a while. And there are lots of different types of investors. So moderation driven by affordability and supply impacting pricing power.
So what we've seen the last 12 months are just some examples. For example, is I've had a couple of people quit their jobs so they could flip homes, number one. And secondly, a lot of the banks we look at have gotten really complacent on underwriting of the builders. And they're real skinny. You know, if you look at their liquidity, these builders, it's very skinny. And they'll show, you've seen this many times, they'll show a great net worth, but it's all in something besides cash. And so you never know how it's going to end up. But those are great numbers. We have included here in this interview 2 or 3 times through here, Ivy, how to get in touch with your firm if they'd like to use your research and get more information on what you do, which I would encourage anybody to do that, particularly any of the big banks watching this. And secondly, and Ivy didn't ask me to do this, but I want to tell you something. This is a fabulous book, and I want to tell you why it's a great book. It's a great book about calling a number of calls on the real estate market, but that's not the best part. The best part, and I would encourage this for all you people that have young people in the workforce and go into the workforce, it is a wonderful book about overcoming. And Ivy has written something that I would encourage everyone to read, but particularly young people coming into the business world. This will give you some push. And I think that, Ivy, it's a great book. I just want to compliment you on it.
Well, thank you very much. Nice surprise. Thank you, Ted.
And then and lastly, thank you for being with us. As always, your information is better than anybody's, and we're glad you're here, and we'll hope to see you again next year.
Very soon. Thanks. Happy holidays, everyone.
All right. Thanks, Ivy.